So let's talk about why dividend stocks outperform during market volatility. This is a fun one because we're so emotional so often about so many different things, but right now we're going to focus in on market volatility.
Yeah.
So,
And really probably the negative volatility of it, right?
well, yeah, we're not going to talk about the highs. We're going to talk about the lows. So help me understand, or give me your opinion. When the market crashes, why do so many investors make bad financial decisions?
Because we're emotional creatures. Like when you open up whoever you're with, you open up your bank and all you see is red, it's a visceral response. Yeah. Red immediately means stop, something bad's happening, I've got to change this. And especially as the closer you get to that quote unquote retirement date, the more emotion you're like, I have lost everything. I don't know what I'm going to do.
So we had a client in our office a couple weeks ago.
Yeah.
And how does she call it? The fragile years.
Yes, she goes, I am in my fragile years and I'm just trying to hang on to what I've accumulated.
So, I mean, there's so often that you get in front of somebody, they're on the threshold of retirement, and she used a word I had never heard of before in that context, where she says the fragile years. And I said, what do you mean by that? And she said, and you know, I'm sure there's a lot of people out there that are going to relate to this. I can't afford to lose a lot right now. You know, when I was younger or I was building up at certain points in my career, if the market went wacko, sure. But right now, I'm like in my 60s.
Yep.
I can't afford a very big loss right now. I mean, who's been right there?
Yep.
Okay. That without any income is a legit statement.
Sure.
When you're dependent on growth as king, you know, you hear cash is king, which I totally agree. Well, for investing, a lot of people don't say cash is king. They say growth is king.
The traditional way of investing.
Because I need my money to grow so I can take out cash.
Yes.
Okay.
And not take out more than I'm actually
I don't want to
growing.
spend any principal. I just want to live off of my growth. What happens when the market crashes and there's no growth to be had? That's why you get this I'm in my fragile years type of mentality. Okay, so let's bank this horrible conversation, which is totally relatable, and let's talk about the impact of dividend stocks in that downturn environment, that big crash. Let's just say you're that worst investor of all times, and every single time you purchase something, it falls.
Which is everyone's fear, right?
You buy at the high, okay, and then the market crashes. Help me understand, you buy at the high on a growth stock, what happens? You just lose your shirt.
You lose your value.
Okay, it goes down?
Yeah, the value of what's on paper is lost, but you really solidify it when you actually have to take money out. You are in those retirement ages.
Or you're just you're not in the retirement years and you're just that investor that just wants to move forward. And you're like, I don't want to lose money. I'm not going to make anything if I just sit in this stock market. I got to see some positive type of return. Okay. So throughout my career, I've noticed one refutable fact. The market really goes in two cycles. And you're going to think, oh, he's really smart. The bull and the bear. No, that's not what I'm talking about. I'm talking about value or growth. The market either is in a growth cycle to find return, or it's in a value cycle to find return. So what really happens here is, like the last several years in the market, we've been in a growth cycle. The big money, the money that moves the market, is shifting some out of value and overweighting growth. So you're seeing this huge trend of growth stocks.
Yep.
Okay. Not growth as in growth of the market. You're seeing the growth stocks surge and value stocks
just kind
of doing their boring thing where you'll see people say, I'm just not making that much money in dividends. Then you see the market turn, where it pulls all of that money out of growth and it surges that into value, where the markets themselves you start to see turn red and fall badly, where dividend growth tends to surge. That's why in bad market turns, bad market environments, you'll see a lot of red in the market in dividend stocks. Value stocks will either be stable or growing. Okay, like 2000, 2001, 2002, the market lost 10, 12, and 22%. I mean, it combined 50% downturn in 3 consecutive years, which is crazy. Mm-hmm. Dividend stocks actually grew in spite of that. And that's the best picture I can give, where there's this cycle of growth through the 90s. Dividend stocks did very, very well, but they underperformed growth.
Sure.
But then the moment the bubble burst, stocks or dividend stocks held their own, grew when the rest of the market lost over 50%. If you never sold, you lost 70% of your value. And yet dividends never really came down.
Yep.
They stayed up, and everything else had came back to this horrible situation. And that's where that 15-year market comes in. When you can go past 15 years, value always stands tall because it never really gets crushed. I mean, during the pandemic, our portfolio was widely volatile. That's once every 15-year type of cycle. They got crushed, but they're break even by the end of the year, just like everything else.
Yep.
Because that wasn't a financial breakdown or meltdown.
That was
a worldwide,
that was an outlier.
Yeah, crazy situation.
Yep.
So let's talk about some statistics.
Yep.
Value versus growth. So during 2008 financial crisis, this is a big one. A lot of people remember this one. Okay, a lot of things imploded. The broader markets dropped 38%. So the growth indices out there dropped 38%. Dividend Aristocrats only fell 22%. Help me understand, what is an
aristocrat is someone who's been paying a dividend for greater than 25 years. So they have this long history of actually paying a dividend, most of them even increasing their dividend payment. So, you say that the S&P was down 38%, these aristocrats were down 22%. Probably what's not even being factored in there is some of that you also got your dividend payment in addition to that. So you're getting some cash payment as part of a return that's probably not even being factored into that.
Which is crazy. All right, so here's an awesome study by the Ned Davis Research Foundation from 1972 to 2019. So you've got, what is that? Almost 50 years, 30 or 47 years. A lot of years in there, all right? The stocks, non-dividend paying stocks, grew on average, what? 2.4%.
Jeez.
That is unbelievable. So a non-dividend paying stock over 50 years, and this is like averaging them all. So I'm sure there are stocks that did very, very well and stocks that did horribly pathetic. So non-dividend paying stocks as a whole averaged 2.4%, which is just ridiculous. This is why investors get irritated. Mm-hmm. Like, I'm not making any money in the market. I need to do crazier things. I had somebody email me this week saying, I need you to look at my 401k. I'm not aggressive enough. Over the same period of time, the overall market averaged 8.5%. So if you just
loop everybody in.
Okay. So you earned 8.5% over that same from 1972 to 2019. So this is why people buy indexes. Mm-hmm. It's like, hey, I'm just going to why not just be average? I'll go in and do whatever. 8.5% sounds pretty good. It's a lot better than the 2.4 stock.
That's exactly right.
Yeah. Now let's look at the real winners of the story here. So if you owned dividend growers, okay, this isn't just dividend payers. This is dividend growers. Over the same 1972 to 2019 period, those had a total return on average of 12.87%. So you got the non-growers, non-payers, boring old, I'm going to beat everybody up growth stocks. They averaged 2.4%. The market, the broader markets, everything looped in, earned 8.5%. And dividend growers, as an isolated group, did 12.87%. That's why I continually say, over longer than a 15-year period, you'll never outperform value. They do so much better. I mean, these are real statistics. These aren't made up. These are legit. All right, so dividend yield during market declines. Okay, this is one of those, like, we get into this conversation all the time with clients. Okay, help me understand, what's a yield?
So the yield is simply just what is their dividend that a company's paying out against their stock price. So the greater the stock price is, with a company's dividend, the lower the yield is actually going to be. So if you've got a company that's paying $1 dividend and it's $100 a share, it's 1%. But if it drops to $50 a share instead of your $100 a share, they're still paying that $1. But now that's 2% dividend yield. But then the same thing is there. If that $100 stock goes up to 200, now it's a 0.5% yield.
So a couple notes on this. This is where this gets really, really tough. Okay, understanding yield. Yield is just the emotional impact of where the stock price is on any given day versus the actual dollar amount that a company pays. And the yield is very emotional because it's reflecting the current stock price, which is very up and down, versus a very steady dollar amount.
Right.
Okay? So you have basically, in my opinion, if you want to see the true value of a company, you look at their financials. I've heard that phrase, when I was growing up, my parents said it to me, my kids are growing up, I say it to them, show me your friends, I'll show you your future. Well, you show me your cash flow, I'll show you your future. So for a stock company, so if you want to look at free cash flow, you'll understand where a company's going and the trending of where that free cash flow is. So when I look at dividend yield, you can make some really, really bad decisions as an investor looking at just a yield. Because you're going to go, why would I buy a 4% yield when I can go buy an 8? There's so much more behind that. Don't get caught into the yield trap. There's one time in my career where I was like a kid in a candy store when I was looking at yields. Because most of the time you look at a yield, it's a trap. It's actually, there's literally a phrase that's called the high yield trap. But there was one time in my career where there were so many high yields and it wasn't a trap, and that was the pandemic. And that was a situation that hit the American economy, the global economy, what do they say? The tide affects all ships?
Yeah. Typically it's a rising tide lifts all ships.
Yeah.
This was a sinking
tide. But it affected everything, and it wasn't based on, so if a stock drops 50%, 30%, there's typically a rationale behind that. In this situation, stocks got crushed. So in May, I'm looking at our portfolio and I'm like, we need to make some changes. And we had like a smorgasbord of investment opportunities out there where we can go and buy yield and look at their actual yield and go, that's an incredible buy. Not because it was paying 9% or 11 or 15%, but because it was paying that, but it had nothing to do with the actual stock.
Yeah.
Okay. It was just a global pandemic. One time in my 25-year career have I had an opportunity like that. I'm not sure. Hopefully I'll never have that opportunity again. I say that because I don't want investors to look out there and go, oh, we'll just wait for the next opportunity.
Yep. Or I'm just going to pull up some dividend-paying stocks and pick the ones that have the highest yield.
Don't do that.
Yeah.
This is
more times than not, their yield has gotten high because of their poor financials and they're getting ready to have to adjust something, either cut their dividend or
how many times you heard the story, it's too good to be true. Yep. With a high yield, typically it's too good to be true. Not always, but there are a lot of opportunities for good stocks that you have to do your research. Like you have to look into. We'll have some shows on some of that stuff.
Yep.
But that's not for this show. But don't get sucked into that high yield trap. Give me a takeaway from today.
Dividend stocks are they give you the consistency in a very inconsistent market. There's a lot of years where the greater market will be negative, and because you own dividend-paying stocks, or if you own dividend-paying stocks, that can be like growth for you. That could be the only place you're actually getting real return.
Yep. So my takeaway is pay attention to the stats. I went over quite a bit of stats. These are just a few. Do your own research. At the end of the day, statistics don't lie, or at least they shouldn't.
Yeah.
In political environments, you're like, is that right? But financial statistics should be pretty cut and dry. And statistics, they all state the same thing. Dividend investing is the best way to grow your money over time.
Yep.
And it pays per retirement, pays for stuff, pays for college education. You could use that dividend for so many different things. there's so many real reasons to own a dividend paying stock. And when you do the right thing and understand the research and buy the right companies, once you go dividend, you never go back.
Well, it's the only place in the market where you can go get real cash for someone holding your cash.
I know. Meaning you buy their stock,
Yep.
they pay you cash.
Yep.
It's the only place you can do it. It's so great.
It is.
Thanks for watching.